Equities doing okay. Bond yields keep on climbing. 8 straight sessions at the front end. Live from New York City this morning. Good morning, good morning. Futures just a bit softer. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, plenty of optimism, but no sign of a debt ceiling deal. As Yellen doubles down on an early June X date, Fed officials are reluctant to commit to a pause. We begin with the big issue. Lots of happy talk, very little substance. Speaker McCarthy indicating the tone was better.
I felt we had a productive discussion. We don't have an agreement yet, but I did feel the discussion was productive in areas that we have differences of opinion. The tone tonight was better than any other time we've had discussions.
The president agreeing talks had been productive. Writing in a statement, we reiterated once again that default is off the table and the only way to move forward is in good faith towards a bipartisan agreement. Here's President Biden explaining their differences.
Here's a disagreement. I think we should be looking at tax loopholes and making sure the wealthy pay their fair share. I think revenue matters.
As Biden opens the door to that, Speaker McCarthy closing the door on tax hikes.
I've been very clear with the president from day one. We're not going to raise taxes. We've got more revenue coming in to government in a 50-year average than any other time in the history.
So for now, we're going nowhere fast. The clock is ticking, and Secretary Yellen is doubling down, telling congressional leadership it is highly likely that Treasury will no longer be able to satisfy all of the government's obligations if Congress has not acted to raise or suspend the debt limit by early June, and potentially as early as June 1. Bloomberg's Candy Lyons joins us now from D.C. for more. Morning, Kaylee.
Good morning, John. Well, at the very least, President Biden and Speaker McCarthy yesterday agreed their talks were productive and that default should be off the table and a bipartisan agreement is needed, but no such agreement yet has emerged. Now, we know that negotiators after yesterday's meeting at the Oval Office did return to the Capitol. They spoke until late at night. They will be meeting again today, and Speaker McCarthy said he expects to speak daily with President Biden, even if not in person, until a deal is reached. But it still is the work of getting a deal that needs to be done, John. Spending cuts, spending caps. What levels are we cutting back down to? Is it being held steady from the spending levels of last fiscal year? These are questions that are yet unanswered, as well as other reforms such as permitting, work requirements for entitlements, and the clawing back of unspent COVID funding. We're still waiting fully for a deal to take shape here. And just a reminder on the clock, you just were speaking about the warning from Treasury Secretary Janet Yellen yesterday. June 1st, really still the date she is pointing to as the earliest for a potential default. That is 9 days away. And even once we get a deal between Team Speaker and Team White House, we have to keep in mind that that needs to be turned into legislative text. That could take another day or two. Then Speaker McCarthy said he will not waive a rule that mandates that he has to give those in the House 72 hours to read that legislation. That needs to be passed by the House, which will not be without hurdles, considering progressive Democrats may have issues on one end, the Freedom Caucus and those on the far right may have issues on the other. And then it needs to go to the Senate, which also could be a bit difficult to get the full 60 votes that are needed. So the timeline here, John, is very, very tight, and yet there is a lot of work that remains left to be done.
It raises questions about what the effective deadline actually is, Kaylee. Greg Valliere earlier on this morning, we caught up with him. He said this over at AGF Investments. If the X date really is June 1, we're in trouble because there simply may not be enough time to write the deal into legislative action language, then give lawmakers time to actually read it. He said if the X date is around June 6th or 7th, there may be time to reach an agreement. Is there a feeling, Kaylee, of when that drop dead date might actually be?
I mean, if you listen to the Treasury Secretary, it is far earlier, but I've spoken with lawmakers in recent weeks, John, who have really called into question the idea of June 1st being the drop-dead date. Republican Senator Mike Rounds told me he thinks that there is some room to fudge it there. Another Republican Senator, Kevin Cramer, was saying if Janet Yellen can find an extra few weeks, that would be helpful. So clearly they do still feel like there is some wiggle room on the timeline, John. The question really is is there. And we have to keep in mind that the date we're working with is not just the drop dead X date. It's whether or not we get too close to it that it becomes dangerous and questioning to the United States' credit rating, as we saw in the 2011 episode. And that is something that the Treasury Secretary has consistently warned about, as well as the idea of cutting it too close to the edge.
Kayleigh, wonderful work as always. We'll catch up with you later. Kayleigh Lyons on the debt ceiling debate of the moment. Joining us now to discuss Bank of America's Jared Woodard, Sarah Hunt of Alpine Woods. Sarah, let's start with you. I think a lot of people looking at this situation just thinking, seen this before, going to ignore it. Maybe I'll add some risk and buy equities before everyone else does after this is settled. Others, Marko Kolanovic over at JP Morgan, saying it's time to buy gold. Buy gold and maybe rotate out of energy. Sarah, what are you telling clients?
Well, I think that this is just an additional problem that we're experiencing that adds to whatever is going on in the backdrop. I think the upside is that if you get this resolved, then you've got equities looking a little bit more optimistic. But we still have a lot of other things going on in the background that are not very happy. And that is a lot of the liquidity that's going to be draining away. There's also, you're still tightening, so you still have that aspect. And yet stocks are acting like, well, if the Fed cuts, it's a great thing for stocks and that's all going to be fine. Whereas we think if the Fed cuts, it's because things look a lot more grim than they do right now. So I think you have a lot of cross currents going on right now in the equity markets.
You're not alone. Not all cuts are created equally. To your point, some are bullish if you do get that immaculate disinflation. Others are bearish if you get a collapse in growth. Jared, I think we go back to the old age question, the age-old question of the last 12 months or so. Am I investing for a world of 5% rates and sticky inflation? Or should I be investing for a world of inflation returning back to target and rates coming back down to 2 or 3?
Yeah, Jonathan, I'm glad to see you because I think this is the most important question that investors have to answer this year and years to come. Our view is that we're shifting back from a world of the 2% kind of world of the last couple decades, 2% inflation, 2% Fed funds, 2% wages, back to the long-term average, which for the last 100 years in the world economy has been more like 5% for those big macro variables. You've got 5% Fed funds now, 5% corporate bond yields. We think we'll see 5% unemployment or possibly higher in due course. And the simple truth is that if we're rotating back structurally to a 5% world, then portfolios have to be radically rethought, and the asset allocation most investors have today is not well suited for that rotation.
So Jared, build on that. What does that mean for the stock-bond correlation going forward from here?
Well, it means in asset allocation that the old 60-40 idea that we've been hammering against for years, that treasuries and other kinds of bonds would be a good hedge against equities, simply isn't true. We know that in the long run of history, stocks and bonds tend to be much more correlated than they have over the past 20 years. You saw really forceful evidence of that in 2022, worst year for 60-40 possibly ever. And many investors still haven't woken up to the fact that there's a lot of risk in the Treasury market, that on any given month, any given quarter, those risk-free supposedly bonds can be a source of incredible pain. And it's not just in bonds, in equity portfolios as well. When indexes are dominated by long-term growth-oriented stocks, the way that the S&P 500 is, you've got to think differently about where your equity dollars should go. And I think the simple answer is not into cap-weighted, large-cap benchmarks of stocks.
Well, I heard that at the start of the year, and then the Nasdaq absolutely ripped. Sarah, let's talk about this relationship between the bond market and what's happening in stocks right now. The bond market, last 8 sessions, 8 consecutive days, yields higher at the front end. It's a 50 basis point move. The Nasdaq, totally fine with it. Sarah, what is the relationship between large cap tech, the big weighting, the muscle of the S&P 500 and the bond market right now?
Such an interesting question, because the reason that stocks were down reportedly last year on the big tech side was because those interest rates were rising. Now you see interest rates rising and there is absolutely no reaction for those big mega caps. Some of those are very profitable. So for them, a higher interest rate isn't really an issue. A lot of those are cash heavy. They're not debt heavy. They don't need to raise money. So for them, it's much less of an issue. But to build on Jared's point, I think that's an excellent point. We had a decade of very low interest rates, of a lot of stimulus. And now we're looking at trying to take out some of those excesses. And to think that that can happen in the 12-month period that we've just experienced, to me, seems a little optimistic. And I think that you're going to have to look at going forward, what does this market really look like? The idea that we can cut rates so quickly when we haven't even really gotten rid of inflation seems a little also optimistic to us. So I think that what you're going to see is a very different outlook going forward. When rates stay higher longer, I don't think that that's going to work as well for a lot of the areas of the market that have been benefiting from the recent idea that we're going to start cutting rates.
Well, let's talk about what has been working a little bit more. Meta, cost cutting, stocks ripping. Microsoft just has to mumble the words AI, the letters AI. The stock adds another $10 in the pre-market. A FOMO mount up or something more fundamental? Jared, how would you describe this run that we've seen in some of these major mega cap names?
Well, there's some crowding into hot themes. We know how that works out in history 9 times out of 10, unfortunately. We also know that there are huge analogies, very important analogies today with some other bubble-like periods in the market. We can talk about .com, but I'd rather talk about the Nifty 50 in the 1970s. We did a lot of work on this last year, and what we found, looking at the fundamental granular data, was that in the 1970s, after a huge round of fiscal stimulus, Great Society, war on poverty, et cetera, investors felt like they had to own the mega cap growth darlings of the day. That ended in tears when high inflation meant big Fed cuts and recession. And the sad truth is that those Nifty 50 stocks were basically dead money for a decade. You had to wait 10 years just to claw your way back. Many of those companies, very importantly, turned from growth stocks to value stocks in the interim, started paying out dividends, started doing more shareholder-friendly measures. And I think that's actually the future for many of the mega cap companies today. The rough patch is you have to be revalued as a value stock, not a growth stock, as you make that transition. And I think it's very early innings, and it's one of the reasons why we favor equally weighted equity investments over cap-weighted benchmarks.
So the cyclicals, Jared, that's what you like right now?
Yeah, absolutely. I think that natural resources, the old economy sectors, energy, materials, industrials, these are sectors of the economy that accounted for 40, even 50% of the market cap of the S&P 500 for much of the 20th century, down in the low teens today, as all the tech and growth darlings account for half of the index. Well, I think that mean reversion has just begun. It'll take some time. It's a structural shift, not a fast one, but investors who own those real asset exposed companies and sectors, I think, are going to be in much better stead for the years to come as inflation remains persistent, demographics turn stagflationary, energy policy very stagflationary. I think you've got to own those real assets that generate cash flows today, not growth stories that might generate some returns far out into the future.
So, Jared, I'd love your response to this then. Marko Kolanovic over at JP Morgan, within commodities, he said this: we rotate from energy because of two things. One, recession risks, and two, potentially a fading China growth impulse. Going from energy to gold. What would you say back to that, Jared?
I love gold. We've got buy ratings on some gold ETFs, but I think for a longer term, aside from the tactical, a blocking and tackling of any given month, I think it's important to recognize that most investors have almost no exposure to energy, almost no exposure to materials, very little to industrials. I think these natural resource and real asset investments are incredibly important for the medium term. I think that the people are even underestimating the supply issues in the energy market, even in the short term. We think you've got to own all parts of energy. You've got to own fossil fuels. You've got to own metals and mining, which are the big winners if the wind, solar, battery transition, comes to success. And I think you've got to own nuclear power as the bridge to the future.
Sarah, I want to give you the final word because I know part of this story you're a big fan of.
So if I think about energy, the reason that you would look at switching now is because you're just looking at the demand side. And I agree. I think the supply side has had a lot of constraints in the last couple of years because nobody wants to invest there. I think you have to look at the entire chain because you cannot simply get rid of fossil fuels on the timeline that we're talking about. It's nice to talk about that, but the odds of that actually happening are very, very low. And if you don't want to take your standard of living down. So I agree. I think that owning all parts of that chain, you're going to see some volatility as you see with the demand picture. The supply picture is very much going to be in the focus. And I think that there is plenty of room for all of that stuff to perform very well over a longer period of time with some volatility in between.
Sarah, Jared, stick with us. We've got to talk about the Federal Reserve as well. Equities right now on the S&P 500. Session lows, actually. We're negative 0.4%. The opening bell about 17 minutes away with some movers. Here's Abby.
Let's start with some breaking news we had moments ago. John, Apple has announced a new multi-year, multi-billion-dollar agreement with Broadcom for components made in the U.S. Broadcom will develop 5G radio frequency components and wireless connectivity components. You can see Apple down about 0.5%, perhaps taking stocks to session lows. Broadcom up popping from the negative to the higher, now up 3.1%. PacWest, another big up day if the gains hold, up about 15% in the pre-market after closing higher by more than 19% yesterday on that sale of $2.6 billion in real estate loans. Dick's Sporting Goods up about 2%. The first quarter beat, sales by 1%, adjusted earnings by 9%. Demand is holding. Lowe's beat, but they cut their outlook similar to Home Depot. And AutoZone, their sales missed. March was weaker. You can see that stock down by nearly 3%, John.
Abby, thank you. Futures down as well, going into the opening bell. Coming up next, don't call it a pause.
Let's take it one meeting at a time. Let's take it a couple weeks, one day at a time, and just let things play out.
That tedious conversation up next.
The Fed speak this week, the Fed speak last week, wants to set up markets to be pricing in what the Fed wants to do going into the June meeting.
Having a hard time pausing.
They don't want to explicitly use that word pause.
If they do anything, it's a skip.
A skip.
This is a very different dynamic this cycle.
Two-way flexibility if they need a hike, if they need to cut.
We'll have to wait and see.
It's ridiculous, isn't it? Lots of conversation about taking a break from hiking in June. Very few Fed officials willing to call it a pause. President Kashkari reluctant to signal the hiking cycle is over. I think right now it's a close call. Either way versus raising another time in June or skipping. What's important to me is not signaling that we're done. As Kashkari worries about optics, President Bullard is teeing up more action. I'm thinking 2 more moves this year. Exactly where those would be this year, I don't know. But I've often advocated sooner rather than later. Compare that with President Daley, who doesn't offer any guidance for 23 at all. I really think at this point in our tightening cycle, it is prudent to resist the temptation to say what we're going to do for the rest of the year. Mike McKee, you have to read all this like I do. It's getting tedious, isn't it?
It is getting a little tedious. An awful lot of Fed speak, as you mentioned, and an unusual amount of disagreement among members of the Open Market Committee about what they might want to do on June 14th. We've put on the sorting hat and sorted them into camps. The camp that suggests that we lean towards a pause is the smallest, but it is also the most influential because it includes the chairman and the vice chairman of the committee and one member of the presidents who is voting. The still worried camp is the largest. These are the people who think that maybe we do need to go in June. Bullard, Bowman, Barkin, Kashkari, Mester, and Logan have all expressed concerns about the Fed not having done enough yet. And then there is the category that you were talking about, John, that includes Mary Daly. It is the people who have not told us what they think. Now, Chris Waller, an important member of that group because he is speaking tomorrow. He's been a hawk. We'll see where he ends up. And, of course, he has a vote, as does John Williams, who usually doesn't dissent from the chairman. So you could probably put him in the pause group. But the thing that they're worried about is basically this, the idea that inflation is still strong and they need to do more to bring it down. That the real rate, while it has gone up a lot, the white line on the top there, it isn't high enough at this point because we're seeing a lot of people in the markets betting on a rate cut this year. And that loosens financial conditions. So dates to watch ahead where we'll get more information. Obviously, Chris Waller tomorrow and the Fed minutes. We'll see what they were thinking about skip or pause when they met in March. Friday, PCE inflation, that's their indicator. June 2nd, the May jobs report, and June 13th, May CPI. We'll get a lot of trading on all of those. The June 13th will be the most interesting because they're in the blackout, they're in their meeting, and we won't know what they think of the numbers if they turn out particularly bad or particularly good.
You wonder, Mike, whether these debt ceiling negotiations end up in the blackout period as well. That could get messy. Mike McKee, thank you, sir. Jared Woodard, Sarah Hunt, back with us. Jared, what's the difference between a skip and a pause?
I think the difference is, well, I love Mike McKee's sorting hat because it's a great example of this shift we're talking about from a 2% world back to a 5% world. In a 2% world of low inflation and easy money, you don't need a sorting hat because all the Fed governors are unanimous that we should have easy money forever. Today, we have to do all this detailed analysis of everyone's opinions because it's a very fractious, contentious issue, monetary policy, just like fiscal policy, now very volatile and fractious. And all that means for us that higher volatility, higher friction, higher cost of capital requires very different investments.
If they skip June, Sarah, would your opinion be the next move is a hike or is the next move a cut?
I would say that right now, the next move would probably be a hike because, to be fair, we still have a big inflation problem. And again, we've had a decade and a half of easy monetary policy. And a lot of the discussions about how short the distance is between you stop hiking and you start cutting don't really account for a decade of low interest rates and hugely easy fiscal policy. So there's a lot more to unwind here than I think the market wants to look at or contend with.
Would you expect that to be captured in their next set of projections that you get at the June meeting?
Well, I'm not sure that that's going to be captured. I think a lot of this is also wait and see data, right? Because we're still looking for a lot of things to happen that haven't happened yet. But on the other hand, being able to project it, given what we have right now, this labor market is not anywhere near the projections of the last 6 months. And I think that that's one of the biggest bones of contention on the Fed is how strong that labor market is. So I don't know how much you would see that in the projections. It depends on what people are going to try to put in there to let people know what they're thinking.
It's true. Right now, unemployment's just south of 3.5%. Their projection year-end, something like 4.5%. And it is May. Let's see how things develop there. Jared Woodard, Sarah Hunter, the two of you, always a pleasure. Thank you. It is May. As we work through the month of May, just on the calendar, we went through it together. Debt ceiling debate ongoing. June 2nd, payrolls. June 13th, CPI. Day later, 14th, Federal Reserve decision. I've got no idea where we're going to be in 2 weeks. Absolutely clueless where we're going to be by year end, which is why maybe Mary Daly doing something sensible over at the San Francisco Fed by not offering any outlook whatsoever for the rest of 2023. Your equity market right now negative about 0.4%. Yields just keep climbing. This is pretty relentless stuff. The climb at the front end on a 2-year. Yields up by 5 or 6 basis points right now, just south of 440 on a 2-year. Coming up, the morning calls and later, the tale of two retailers. Lowe's cutting its outlook amid lower spending. Dick's Sporting Goods topping profit estimates. That conversation coming up shortly. Plus, we'll catch up with RBC's Amy Silverman from New York. This is Bloomberg. Bond yields climbing on treasuries for 8 consecutive sessions on a 2-year. That's the longest streak of gains of the year so far. And equity is just about to show some weakness. We're negative here by 0.4% on the S&P. On the Nasdaq, we're down about 0.5%, going into the opening bell about 5 minutes away. That's the price action. Let's get you some morning calls. First up, HSBC upgrading Chevron to buy. 189 price target, noting the stock's attractive valuation. That stock is up by a little more than 1% at 154.16. MoffettNathanson upgrading Zoom Video to market perform after earnings, expecting its online business to keep stabilizing throughout the year. That stock negative by 2.8%. And finally, Jefferies naming Microsoft a top pick, seeing more than 20% upside, with the company best positioned for the push into, guess what? AI. That stock just a bit softer, negative by 0.2%. Coming up, RBC's Amy Silverman warning investors to be cautious of the rally in big tech, and what a rally it's been so far this year. That conversation up next. Your opening bell just around the corner. Seconds away from the opening bell, call it about 22 seconds away. Equity futures just a bit softer, negative by, let's call it 0.4%. The Nasdaq for once showing some weakness coming into today after the close Monday. The Nasdaq 100 up by more than 26% year to date. There's the opening bell, switch on the board and get to the bond market. Those gains in the Nasdaq more recently, even with this move higher in bond yields. Just about moving higher on a 10-year maturity. That piece of the yield curve up by 2 or 3 basis points, 374 on 10s. On a 2-year, up another 6 basis points, 8 consecutive sessions of higher yields at the front end of the curve in America. The 2-year, just south of 440 at 437. And I can tell you, as we eat away, take a nibble, so to speak, borrowing that phrase from Kit Jukes of SocGen, out of rate cut expectations in the back half of this year, we take a piece out of those dollar shorts as well. The euro weaker again, a break of 108, 107.75. PMIs out of Europe, manufacturing dreadful. Services just about holding up. Crude better, up 1%, 72.73 on WTI. About 40 seconds into the session, we are lower by 0.5% on the S&P 500. Similar move on the Nasdaq. One stock to watch at the open. Let's check out Lowe's. The retailer cutting its full-year guidance amid a slowdown in consumer spending. The CEO saying this: although we delivered positive comparable sales, we are updating our full-year outlook to reflect softer than expected consumer demand for discretionary purchases. Abby has more. Hey, Abby.
Hey, John. Well, here's something. The stock just flipped positive ever so slightly. Right now, it's down fractionally. This stands out because earlier, the shares of Lowe's in the pre-market, when results were first announced, down more than 3%. Now, the headline that's really did grab attention, that they now see their comp sales down 2 to 4% versus the previous view of flat to down 2%, and the estimate of down about 2%. But we've seen this story again, so investors well prepped for what Lowe's has put out, because of course Home Depot last week cut their outlook on weaker consumer spending. Lowe's talking about similar factors such as falling lumber prices, unfavorable weather, and of course that consumer spending lower on DIY and other discretionary items. Home Depot went a little bit further, saying it was a broad-based pullback. But either way you slice and dice this, it does seem that these two big box retailers that focus on home repair and the like are seeing this kind of a pullback. What's interesting, Home Depot caters a little bit more to the professional person who would be buying these materials. Lowe's a little bit more of the consumer. The stock right now up 0.5%.
Just positive, as you indicated, Abby, turning positive in the last couple of minutes or so. Sticking with earnings, Dick's Sporting Goods topping estimates on Wall Street, keeping its outlook unchanged. The CEO writing in a statement: even as consumers face macroeconomic uncertainties, our athletes have continued to prioritize for us. I can't help myself. They're calling their customers athletes. I find this absolutely ridiculous. It's so silly. Let's get to Kelly Lyons on this. Kelly, are we really calling customers of Dick's Sporting Goods athletes?
Maybe wannabe athletes, John. I would probably put myself in that category. It's interesting to see Dick's Sporting Goods is actually losing the momentum it had earlier in the pre-market session. It was up about 5.6% at one point. Now it actually just flipped into negative territory, fluctuating really around gains and losses here at the opening bell, because you can kind of pick and choose what part of this report you want to look at. You did have a little bit of lightness when it came to comp sales. Revenue was just in line, but you did get that beat on the top line, bottom line, $3.40 a share, topping analyst estimates. And importantly, gross margins also came in ahead of what the street was looking for. The company's CEO talking about market share gains as well as an increase in the number of transactions. So Dick's clearly is outperforming some of its peers, even as we see the consumers pulling back in discretionary spending, or athletes, if you will, in some areas. It's really noteworthy to contrast these Dick's results with Foot Locker from Friday, which were pretty bad across the board, dragged Dick's down along with it. And a lot of analysts this morning noting how this report is far better than expected, given the contrast with Foot Locker. One analyst over at D.A. Davidson saying this report is solid. It's not perfect, but it's more than good enough relative to expectations. Now, the call begins at 10 a.m., John, so it'll be interesting to see what kind of commentary we get out of executives about what kind of consumer they are seeing, or maybe we should be calling them athletes.
Bowling, fishing, game room. I'm on the website right now. Kaylee, come on. Athletes, bowling, fishing.
Yeah, I mean, I'm not good at either of those things, so I feel like I'm not in a position to comment, but athleticism, maybe not what I would use to describe those who do these things.
Katie, thank you. I'm sure I've offended a lot of people at the bowling alley who have Bloomberg on the screen in the bar, or not. Let's turn to the financials. PacWest extending its gains to a second day, building onto Monday's 19% advance. This coming after the bank agreed to sell a $2.6 billion portfolio of real estate loans at a discount. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, just to recap, like you said, of course, the news yesterday was that it's selling that portfolio of about 74 real estate loans to Kennedy Wilson Holdings. That was good for a 19 or 20% rally yesterday. It's building on those gains today, currently up about 16% as trading gets underway. Of course, that move yesterday was part to shore up its liquidity position. Apparently, shareholders really like that. Of course, PacWest is getting a little bit of help from the sell side. This morning, you had analysts over at D.A. Davidson keep their neutral rating on PacWest, but it raised the price target to $8 from $3. For some context here, currently PacWest is trading around $7.92, so pretty close there. But again, for additional context, it's still down more than 60% year to date, John.
Katie, thanks for that. The latest on the banks. The fact we're not talking about the banks so much over the last couple of weeks is maybe good news. Let's shift back to earnings. Shares of Zoom Video are raising their pre-market gains after posting mixed results. Growth of its largest enterprise customers failing and falling short of estimates. Bloomberg's Alex Webb joins us now from London for more. Morning, Alex.
Hi, John. Yeah, it seems to have been a quarter that, despite an upgrade to their expectations for the full year, mildly ahead of what they had predicted before, the market is not taking very well. Citibank calling the raised guidance change to what was already quite a low bar, so clearly not blowing anybody out of the water. The thing that's interesting with Zoom, obviously a lockdown darling with plenty of people heading online for their calls, it has not yet managed to deliver, as companies try to pivot away from being growth stocks, healthy profitability, and it is heralding higher spending on AI as the year advances. So you've already got a company that isn't as profitable as investors might like it to be, telegraphing that it's going to be increasing its capex over the next few months. Investors clearly not taking it brilliantly.
Stock down 7%. Alex, thanks for that. The update on Zoom Video there. The update on the market, if you're just tuning in, welcome to the program. About 6 or 7 minutes into the session, we're negative here by 0.4% on the S&P. Similar move on the Nasdaq, down by about 0.3%. Here's the bull-bear debate of the moment. Here's the bear. Marko Kolanovic at JP Morgan saying we raised the cash allocation in our model portfolio again, this time by 2%, funded by reducing our weighting in equities and corporate bonds. Within commodities, rotate from energy, given what he calls recession risks and potentially a fading China growth impulse, to guess what? To gold. That's the bearish view. Here's the slightly more constructive view. Here's Savita Subramaniam.
When you look at valuations right now, they look high, but valuations generally look high when you're in an earnings recession, which we are in right now. And I think that when you look at the equity risk premium for stocks, it could actually go lower. And our call is the riskiest asset class in the world right now is the risk-free rate. Basically, treasuries are the bubble. If we are in this sticky inflationary environment, do you really want to be in cash or bonds? Don't you want to be in stocks that participate in inflation?
Savita wants to be in stocks. Joining us now is RBC's Amy Wu-Silverman. Now, Amy, I want to start with one part of the stock market that Savita's not a big fan of, tech. We're trying to work out whether we should be positioning for a melt up or a melt down in this sector. Which one is it, Amy?
Yeah, it's a good question. I guess I might argue that we have had the melt up to some degree at least, and it's certainly given a lot of shorts a lot of pain. Look, you and I have talked about this before, but if you just go 10,000 foot view and just look at the Sharpe ratios of some of these mega cap tech stocks, you have Apple and Nvidia having negative Sharpe ratios. Essentially, that risk-free rate to return trade-off is just saying you're better off in cash, given what we expect the upside to be in these tech names. So you either have to believe that AI or something is going to really continue to drive these shares up, or you believe that there's going to be volatility to that risk-free rate declining. But, you know, as it stands right now, those are negative Sharpe ratios.
Do you think we are better in cash then?
I think depending on where you are in the sectors, yes. So we took a look year on year, John, at every single sector and just said, look, what's the trend in Sharpes? And every single sector has declining Sharpes. Information technology is the worst. The single sole survivor that has a rising Sharpe ratio year on year is the energy sector.
Is energy something you want to get upside risk to, upside exposure to, Amy? Is that something you advocate for? We caught up with Jared Woodard in the last 30 minutes or so. He said yes. Sarah Hunt, Alpine Saxon Wood, she said yes. What do you say?
Yeah, it's interesting. So look, what I always focus on it from a kind of reverse engineered perspective. I want to know essentially what consensus is telling me. So when we computed those Sharpe ratios I mentioned, we basically said, you know, what are consensus 12-month price targets across the board? You know, not just RBC's, everybody's. What is the market telling you? And the market is essentially telling you that really the only upside they see and the only risk-adjusted return upside they see is in that sector. Now, when you take a look how to play that tactically using options, those are actually relatively inexpensive calls right now. So I do think that's an interesting trade to participate in as long as we head into the summer and kind of get that volatility tick up.
Amy, could you offer me some more clarity as well on just positioning around the tech story? You mentioned there about burning through shorts. For sure, we have burnt through shorts around tech, given the move we've had so far year to date. How light is positioning now?
It's really interesting. Sometimes when I think about positioning and reading those tea leaves, it's a little bit closer to astrology than it is to astronomy. But that being said, the thing I focus on the most is just the dispersion you're seeing in the market. So when you think about tech, and when you think about mega cap tech in particular, those 7 or 8 stocks that you consider mega cap tech are contributing so much to the return that we see into the market that, again, we've talked about this, you could get kind of value outperforming growth or any of these other factor reversions. But if you don't get it in those 7 names, you could actually get a drawdown in the market as a whole. So when you think about positioning, I think people have this fear that they do need to participate in the stocks that have the largest contribution to return. But when I speak to clients, they're ready to deploy certain trades like small cap versus large cap or value versus growth, but they do think we need to get a washout first. Maybe that happens with the debt ceiling. Maybe that happens with something else, but I don't think we're quite there yet.
Can we just throw in the debt ceiling debate, Amy? What are you telling clients about that at the moment? Because I think a lot of people, what they want to say is ignore it. What are they actually saying to you, and what are you saying back?
Yeah, the debt ceiling, I know last time we spoke, I called it kind of a paddling duck environment. It feels like the 3rd trimester of pregnancy. It's going to get exciting soon, but it isn't yet as we approach that X date. What we really like in terms of trades is we like low cost convexity grabs. So that could be to the upside. It could be to the downside. I can tell you the downside is much more expensive right now relative to the upside. I continue to think that upside is underpriced, meaning the idea that Biden and McCarthy could just find a solution and could go quickly and easily is underpriced. But, I think people model back to 2011. They plot that VIX graph to 2011. They just say, man, look, we're kind of in a 16, 17 handle right now, but we got as high as 48.50. And that's the fear right now. That's why I think you see a lot of demand, again, for that downside tail relative to that upside tail.
Amy, love catching up with you, as always. Amy Silverman there of RBC on this equity market. Equities right now, about 12 minutes, let's call it 13 minutes into the session, just a bit softer, lower, negative by 0.3% on the S&P 500. On the NASDAQ, we're down by a similar amount. This move on the bond market sticks. Yields up again, 8 consecutive session, up another 6 basis points. We've gone from something like 390 around that level on something May 11th, all the way up to about 440 on a 2-year over about 8 sessions or so. And with that, you breathe some life into the dollar again. Dollar stronger, euro weaker, a break of 108 again today, 107.76 on that currency pair. Coming up on this program, airlines gearing up for a busy summer of travel.
If we have another strong year and we have significant net cash balances, then we'll return those to shareholders.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Goldman Sachs co-head of Global Credit Finance, Christina Minnis. That conversation at 10 a.m. Eastern, 3 p.m. in London. This is Bloomberg.
We're paying down debt at the moment. I've paid 2 bonds this year, 1.5 billion of debt. I've only got about 2 billion of debt left. I paid that all down in 2025 and 26. I'm spending about just over 2.5 billion a year in capex, which I'm funding out of internally generated cash flow. I think maybe next year, if we have another strong year and we have significant net cash balances, then we'll return those to shareholders. I think it's coming, just not yet.
It's fair to say they're having a strong year. That was the CEO, Michael O'Leary, great character of Ryanair. The outlook for the airline's improving, and here in the United States too, ahead of the Memorial Day weekend. US air travel returning to pre-pandemic levels and some, but the index trading 40% lower than it was back in 2019. Katie Graffard has more. Hey, Katie.
Hey, John. Well, it's a mixed bag for the airlines this specific morning. You do have United, Delta Southwest a little bit higher or so, American not as much. If you look on a year-to-date basis, even though the index overall is still below, of course, its 2019 levels, the group has fared pretty well. United Airlines, it's the clear outperformer. You can see it's up by 26% so far in 2023. American and Delta as well putting up gains. Southwest, not so much. It has some unique troubles. We heard from its CEO last month that its holiday travel struggles, it's hurt Southwest's brand overall, apparently its share price as well. But the group, it's been performing well, even though airline costs have soared since the pandemic. Operating expenses has climbed at all four companies. Think of labor costs, fuel costs, continuing to be an issue even as the travel outlook improves.
What's good for them isn't so good for us, for anyone who's been on a plane recently or to the airport and experienced how busy things are at the moment and how much money they cost. Katie, thanks for that. Just an update on the debt ceiling negotiations. According to one lawmaker down in Washington, D.C., bit of colour on how things are going, according to Kevin McCarthy, telling the GOP a deal is not close yet, urging Republicans to stick together. Just more mood music for you. Here's a couple more headlines. I'll read them again. Urging Republicans to stick together, telling the GOP a deal is not close yet. Although apparently talks were productive, things were constructive, and all of the above. We'll be doing this all day on Bloomberg TV and on Bloomberg Radio. Katie mentioned the airlines. Now, how is the economy doing right now? It depends where you look. Services at the moment, good. Manufacturing, not so good. We saw this in the European PMIs a little bit early this morning. Mike McKee, do we see it in the United States as well?
Exactly the same story, John. We see the manufacturing PMI, this is the S&P Global, go down into the 40s, 48.5 from 50.2. So a drop in manufacturing, but services rise. The S&P Global U.S. Services PMI at 55.1 from 53.6. So that's a fairly significant move. The composite comes in at 54.5 from 53.4 because, of course, services are the biggest part of the economy. You mentioned Europe, same story in France, in Germany. The overall manufacturing index falls into the 40s in all of those countries and in the Eurozone in general. But the services index and the composite index are both up in all three of those areas into the 50s. So people have switched to spending on services, but they do seem to still be spending.
So, Mike, with that in mind, what does that mean for the backdrop for inflation and ultimately for the Federal Reserve? If you looked at the PMI for manufacturing, you might make the argument that maybe they need to cut. If you look at the PMI for services, you might make the argument that they need to keep on hiking.
That's why we've got the Fed on two sides of the equation at this point. It does suggest that there's still going to be inflationary pressures in the economy, and the Fed in the United States, of course, is worried about services inflation based on the fact that companies are having to pay up to find employees. So we have to keep an eye on that, and we'll see what happens when we get close to June 1st and get that ISM number, the national sort of number that everybody looks at for manufacturing in the U.S.
Bit more data for you. Mike adding some more to the calendar. The ISM there, of course, payrolls June 2nd, CPI June 13th. A bit more Fed speak this week as well. And Mike McKee, thank you, by the way, as those PMIs come through. Services okay. Manufacturing not so good. Fed speak, Governor Waller, as Mike indicated, look out for that coming up tomorrow, then Fed minutes tomorrow afternoon as well. Let's look at the broader market. We are recovering just a little bit. Early days here, the session young. We're about 22 minutes, 21 minutes into the session. We are negative by 0.2% on the S&P with some sector price action. Here's Abby.
John, not surprisingly, with that slight decline, we have more sectors down than not. To the upside, though, energy is the best sector on the day, up 1.5%. Of course, Chevron getting that upgrade that you mentioned earlier after that acquisition made yesterday. Oil is higher as well. Interestingly, utilities and real estate higher despite the fact that yields are higher. And as you mentioned, relentlessly over the last 8 days, typically those dividend-rich sectors wouldn't do so well. On bottom, materials, consumer staples, and industrials. And then let's take a look on the year. Very interesting conversation that you had with Amy Wu Silverman, where she was talking about Apple and NVIDIA having negative Sharpe ratios, which mean you'd be better off in cash. There's tech on the year, but then she was saying, or excuse me, that's a one-year view, but on the year it's a similar look. Energy is the one where she would be buying, and that is down. So it does look like maybe there is a buying opportunity there for energy, and maybe tech is a little bit overbought.
Abby, thanks for that. Views divided on Wall Street, as always. If you are just tuning in, just an update on the debt ceiling negotiations. High-level talks, of course, took place yesterday evening. Speaker McCarthy said they were productive, constructive. Pick your word. The mood music seemed okay. President Biden reflected some of that in a statement he released after those talks, too. Just got some comments from one lawmaker reflecting on what Kevin McCarthy, the Speaker of the House, told the GOP. Telling the GOP a deal is not close yet, urging Republicans to stick together. Those two headlines dropping just moments ago. Kevin McCarthy, the Speaker of the House, urging Republicans to stick together and telling the GOP a deal is not close yet. Coming up next, we'll get you the trading diary, the Fed speak through the week, the Fed minutes, and a whole lot more. This is Bloomberg. No drama here, really marginal losses so far in the S&P 500, down by about 0.2%. Similar move on the Nasdaq, really just a touch softer. The Russell touch higher, positive by, let's call it a third of 1%. That's the price action. Let's get to the trading diary. Things shaping up as follows through this week, and we start at the top of the hour. At the top of the hour, GOP House leaders holding a news conference, plus another round of new home sales. The home activity in the United States is doing okay. There's some life there, even with interest rates as high as they are right now. We get the FOMC minutes on Wednesday. Look out for that. You hear from Governor Waller as well. That's worth a look or two. Jobless claims coming up on Thursday. Let's see if they behave. And rounding out the week with the US PCE inflation and UMich sentiment survey, which we all know and love, coming up on Friday. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.